Good morning and welcome to the Call Girls Investment Club. I'm in my pajamas because I decided, since I'm a pajama trader, which is a disparaging description for people who trade stocks. Aren't we all in California pajama traders? We have to get up way before people in New York according to our time zone. And also now with COVID, I think we're all pajama traders, everybody. I wanted to comment on this article I read, and I had so many things to say I decided to do a video. The article is called "The Widely Cited Disconnect Between Wall Street and Main Street Suddenly Appears Less Confounding." First of all, there's like 5 or 6 things I wanted to say about the title of this article. They say it's confounding that the stock market is going so high when obviously the economy is going to be negatively affected by COVID. So first of all, the stock market runs 6 months ahead of, usually 6 months ahead of reality. You can actually tell things about the future by looking at the stock market, because it's almost like people in the stock market realize things before most newscasters do. The only exception to that, I would say, would be when COVID hit the news. Obviously the stock market wasn't taking it seriously because it kept going up for 2 weeks after people should have figured out how bad it was. I think that was sort of like a game of chicken where investors were trying to be the last one out. But the stock market runs about 6 months ahead of reality. The stock market's made up of the larger companies. The people who are negatively affected by COVID are the smaller companies. So the stock market's going up because the larger companies have an advantage with the smaller companies going out of business. Hopefully not many of them will. But it started with a really healthy economy, and so the fact that a temporary event affected it, it's more like a hurricane. When there's a hurricane, stock market maybe dips very temporarily. So that's another reason why they say the curve is V-shaped. Also, I feel like there's a lot of new markets springing up. Like whoever's making plexiglass, man, there is plexiglass everywhere. Mask manufacturers, touchless payment, people involved in working from home. There's like new demands cropping up. So there's like a new economy springing up from this. And finally, the fact that a whole bunch of people panicked and got out and bought bonds, which of course now are crashing in value. They just panicked and got out. Now they're coming back in, and that's not over. There's still a lot more money to come into the market. Hey kitty, can you come out? Thank you. So those are all the reasons why I expected the stock market to climb over the last couple months and why it has. Okay, so let's read, and I know I have a big ego. I'm always talking about how I'm right. I do make mistakes, but I'm pretty good at day trading. That's what I've been supporting my family with for most of the last 5 years. So the first slide says, this is one thing I wanted to talk about. I didn't even mention the tremendous global stimulus and rampant investor anxiety at a moment when the bearish case on an infected spike and long-term consumer caution simply cannot be proven correct for months. Okay, so that means, oh my God, everything's so noisy this morning. So that means basically all the people who are expecting, that means all the people that are expecting negative things, you can't really prove these negative things unless you wait like a month. Is there going to be a coronavirus spike? Well, there's none right now, and it takes 14 days supposedly for this infection to manifest itself. So you can't really prove any of the negatives in the near term. So in the near term, we're going to see an uptick. Okay, the second one says, on Thursday, NASDAQ volume was at an all-time record, which hints at an increasingly fevered chase and potentially an ongoing capitulation for bearish traders. So what is a capitulation? That's when a whole bunch of people bet one way, and then they start to think they were wrong, and more people start to think they were wrong, because as they think they're wrong, they sell their negative positions and buy positive positions. So that creates more of a snowballing effect. That's called a capitulation. Okay, here's slide 3. And I apologize for these crappy little numbers I put on these slides, but I usually post like from bed at 5:45 in the morning. So then I decided to make a video in my pajamas. Yet it's fair to say wealthy individuals and more traditional fund managers have been more reserved. Money continues flowing out of equity funds in a stream into bond funds in a torrent. The wall of worry is certainly shorter, and the tailwind from defensive positioning has diminished, but neither is quite gone entirely. When they talk about wealthy individuals, okay, they're kind of saying the smart money. So supposedly people with a lot of money are smarter. This is the assumption these commentators make when they talk about the smart money. I don't think it's true personally, because first of all, I think wealthy individuals trade in a different manner than smaller individuals. Most people with less money are trying, I consider myself someone with less money, are trying to make bigger profits. People with a lot of money are just trying to hold on to it, so they're making more conservative bets. But a lot of times I think they mock people who are not professionals, who are laying in bed trading. Well, honestly, the professionals are pajama traders now too, because they're all laying in bed trading. But it doesn't mean people are wrong just because they're not rich. I know it makes sense that if people did the right trades, they'd get rich, but the implication in this is they're saying the smart money is like hesitant to get involved in this crazy rally, and that does make sense, because it's at a peak, and here comes the plane. It's at a peak, so I got to be more cautious now. So I trade in different ways, and I'll tell you that in a minute. So I trade in different ways depending on what I see the patterns emerging in the market and where we're at. And we went like down and then up. And I just want to clarify, I'm not looking at the Dow, I'm looking at the NASDAQ, because I only trade the NASDAQ. I think that's the strongest set of stocks. It's all technology stocks. It's not the more difficult things to predict. For me, I just have an easier time trading things like, Apple and Tesla and things like that, which are all in the NASDAQ, so I trade the TQQQ. So I'm just trying to be an expert on one stock, because if I buy and sell it, I can make a lot more than if I try to limit my risk, but limit my exposure to one thing. Anyway, here's slide 4. The big pop in stocks after a payrolls report, such as we saw Friday, which was yesterday, has a mixed record as a predictor of continued market strength. And then they go blah, 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 blah. They talk about it. They're trying to say it's possibly negative, but actually when they did their research and plugged in the numbers, 2/3 of the time it's positive. So I don't think this point, I just want to say, they're like, of 9 other instances, both a week and a month later, it was down 3 out of 9 times. Well, do the math. 3 out of 9 times means mostly it's up. I think they started to write the article and they were going to say it's down a lot, and it turned out it wasn't. I don't think 1/3 of the time is a big negative. I think 2/3 of the time going up is a positive. Okay, slide 5 says, okay, they're talking about this guy, Michael Hartnett, who has correctly been bullish risk assets in recent months based on part on his Bank of America's global strategist Michael Hartnett has correctly been bullish risk assets. Okay, it's not me. Based in part on his bull-bear indicator of sentiment and flows being pinned at 0. The gauge lifted slightly on Thursday, oh wow, they're trying to say, oh, this is a question if it's going to go bad now. The gauge lifted slightly on Thursday. Of the prior 5 times it rose from zero since 2002, the S&P on average added 2.8% the next 4 weeks and 4.8% over 8 weeks. Well, that sounds positive to me. Yet over 12 weeks, 2 instances saw mid-single-digit losses. Well, okay, 2 times it went down slightly. It still sounds positive. It sounds like they're trying to make a case for negative. For his part, writing before Friday's data and market move, he predicted a run by the stock market to the S&P to 3250, but recommended selling it. The index's high Friday was 3211. So the article's trying to say we're close to the top. I don't believe that. I think we were in the midst of exceeding predictions just before the COVID crisis. We had just broken through some key technical barriers, and I think that even though in the past there have sometimes been negative responses to this indicator, there's a couple of reasons. Most of the time the market goes up according to this actual statistic, but also we were already in such a good economy with a positive flow that it's very easy to see a case for why we might go even higher than expected. In this final slide, number 6. But it's worth remembering that many of the same characteristics that suggest this rally is getting overheated in the short term are also ones that tend to only appear in durable long-term advances. So I guess that's what I was trying to say, is I feel like we're on this positive growth climb. So the way I trade, I believe in the market, so I only trade positive. I only buy calls, options that are positive. I only buy the NASDAQ, which is the more technologically oriented market, because in the past I've felt like that's where the growth is coming from, and also because now I'm used to trading that, so that's the only thing I know. When we were in March 23rd and we were going to go up, I trade sometimes longer term because I'm seeing a general trend up, so I bought options that were maybe 30 days out, and if it went down I'd stay in them because I believed in the market going up ultimately. But when we get to a place where I agree with this article, which I don't yet, that we're topping out, then the market kind of does more of a horizontal move. So if that point gets reached in my mind, I'll be doing shorter day trades. I'll be buying maybe two-week options or something and just trading it for the day, buying it in the morning and selling it when it's higher, or buying it in the evening on a dip and selling it the next morning when it pops, stuff like that. So you don't have to, but I kind of change my trading methodology based on what kind of market we're in. This article's arguing we went down, we went up, we're here. I disagree. I think we went down, we went up, and we're going this way for a little bit. So enjoyed that, and please pardon my noisy roof.